Here are the most common taxes you'll run into when it comes to investing in real estate. 1. Capital gains tax. In plain English, capital refers to assets, in this case, cash, and gains are the profits you make on a sale. Basically, if you bought a piece of property and sold it for a profit, you've made capital gains. When you sell an investment property, you'll pay capital gains tax on the profit. Now there are two types of capital gains tax, short-term and long-term. A. Long-term capital gains tax. You'll pay long-term capital gains tax if you sell a property you've owned for more than a year. This type of tax uses your taxable income to determine how much you owe on just the profit you made from the sale of your investment property. Here's an example. Let's say you buy a property for $100,000. Years later, you sell the property for $150,000. That's a gross profit of $60,000. Of course, you also pay a real estate commission fee when you sold the property. Good news, you can deduct that from your capital gains. So, let's say the fee was $9,600, 6% of the property's price. That brings your capital gains down to $50,400. Remember, for long-term capital gains tax, it depends on your filing status and your taxable income for the year. Most taxpayers will end up paying a capital gains rate of 15%, but some higher income folks will pay a 20% rate, while lower income earners won't pay any capital gains taxes at all. B. Short-term capital gains tax. Short-term capital gains tax is even simpler than long-term. When you've owned the property for less than a year, think house flip, your profits are taxed according to short-term capital gains. But if you sell at any point beyond 1 year, those profits will be taxed at the long-term rate. Unlike a long-term investment, the profit you make from a short-term investment is counted as part of your overall annual income and will be taxed according to your personal income tax bracket. Let's say you're single, your annual income is $50,000, and you made $20,000 profit on a house flip this year. Uncle Sam sees that profit as taxable income, putting you at $70,000 total and landing you in the 22% tax bracket. But there is a trick to IT. You can postpone capital gains tax. Say you want to sell a property but plan on investing in more real estate after that. It sure would stink to pay capital gains tax on that sale instead of getting to use it toward another purchase, wouldn't it? Well, here's some good news. By taking advantage of a fancy tax-deferred rule known as a 1031 exchange, you can sell a property and reinvest the profit into what the IRS calls a like-kind investment. In other words, you can postpone paying capital gains tax if you use the profits from the sale of one investment property to purchase another similar property. But you only have a short window of time to reinvest the money in order to defer the tax. 2. Taxation on rental income. Any money you make from rental income must be listed as income on your tax return. But when you own property, you can also claim deductible expenses like repairs and maintenance, but keep in mind that improvements won't count. So maybe you made $10,000 this year from rental income, but you also completed $1,500 worth of repairs on the property. You can deduct the $1,500, making your taxable rental income $8,500. Do yourself a favor and save time by working with a tax professional. Meet with them regularly to discuss your investments and how they impact your taxes. You don't want to get slapped with a penalty.